Now, of course, Newmont is a gold mining company, and so they will have mines across. And this is not just in the United States. This is international. This is a total international business, and so they could sell gold to people who may be interested in buying it. So how this company profits is really based off of how much gold is worth at the time of them selling it. So if gold prices are really low, then they will likely not profit, or they may take a loss. Or if gold prices are really high, then this company may actually profit substantially. So this company has been very profitable in the past. However, it also has lost a lot of money in the past too. So this company really does go back and forth, and so you want to make sure that you swing that quite well when you're buying this company, and then you make sure that you're buying a company at a good price. And that's what I want to get into right now. Now, we consider that the company's intrinsic value is currently at about $42 a share. If we scroll down here, we can show you exactly how we calculate this. This is the projected free cash flow model of calculating the intrinsic value of the company. And so in our videos, I like to talk about the intrinsic value per share of the company because I think it's very important. It gives you exactly a value that the stock should trade towards over time. And so this is very important if you are trying to find whether the company is currently overvalued or undervalued. So here we can see that we take the growth multiple here, which is just a projection of the earnings each year. This is not going to be very high for this company, as this company does fluctuate between profitability and not profitability relatively quickly. And so the growth multiple here is a basic level. Normally it stands to be at about 9.5. That is just pretty typical for a company, and so therefore the growth multiple is going to remain to be at this number until we can determine that the company is going to remain in profitability for the long term. Now, we also have the 6-year average of the free cash flow. That is essentially how you take into account earnings and the projected free cash flow model of the intrinsic value. Then you add the total stockholders' equity, which is simply the assets minus the debt of the company. You multiply that by 0.8 and then divide that by the shares that's staying in the market in order to get the intrinsic value per share of the company. Now, we have to understand that this is, of course, rounded. This is not exactly what the intrinsic value is, and we have to also understand that there's many ways of calculating the intrinsic value too. So please do feel free to check out other ways of calculating the intrinsic value. This is just one way, and this is one way that I think is very simple, and it gets people engaged in calculating the intrinsic value and understanding how it actually works. Now, since the company's intrinsic value is $42 a share, this would mean that if the company trades over $42 a share, that means that the company is overvalued, and if it trades below $42 a share, that would suggest that the company is undervalued. So that is essentially the point of the intrinsic value, and we can also look at the book value here to determine that as well. We consider that the book value here is currently at about $28 to $29 a share, and so we consider that specifically at $20.87. But just for our purposes, we'll say it's $29 a share. Now, if the company does have a trading value of about $29 a share, this would mean that the company would then have assets that would support the trading value of the company. And then if the company were to be net neutral in profitability, like let's say they were not losing any money, but they were not making any money, then this would mean that the company would actually be trading at a fair value. Now, if the company was actually making some money, and this would increase the intrinsic value, and the intrinsic value should be higher or maybe closer to $30 or $31 a share. And so this would mean that the company is now going to trade there relative to just $29 a share. So the company would likely be trading at around $31 a share if the company profited. And then if the company were to profit substantially, and now since the company is profiting quite a bit, the intrinsic value is actually closer to $42 a share like I was talking about before. And this is because the company, of course, like I said, is profiting substantially now. And so this is really because gold prices have dramatically increased recently. And this can be attributed to numerous things. I'm not going to get into exactly how that works. I'll make a separate video on how gold works and other things like that maybe in the future. But the point is that this company currently is making a lot of money because gold prices are high. So basically, as long as gold prices are high, the company should be very profitable for the long term. Now, it's very important to understand that this company will have earnings that will fluctuate quite a bit, and we can see with the net income that this is very much the case. We can see that they have taken substantial losses in the past, actually. We can see that they've taken losses of close to even $2 billion during even a single quarter, and so this is the quarterly earnings. This is the trailing 12 months earnings, which is just the yearly earnings. And so the point is that this would mean that the company is really having good years and bad years. And so during the bad years, they aren't paying dividends, and during the good years, they're paying really strong dividends. So this is actually pretty cool for the company. So since the company is making quite a bit of money right now, they currently have net earnings of about $2.5 billion. This gives them a price to earnings of currently about 20 or maybe even 19. And so that's pretty fair for this company to have a price to earnings of about that. I think that this company should have a price to earnings below 20, and that is currently around the case. Normally, companies seem to have price earnings between 15 and 20. And so this seems to be no exception to that, and I don't think that this is going to change very much unless the earnings, of course, drop dramatically. Now, do I think that the earnings are going to drop dramatically? Actually, it's possible just because the gold pricing can change dramatically, and if gold decides to become quite a bit cheaper to buy, then this would actually cause a major problem for Newmont and also other gold mining companies, because this would not allow them to, of course, profit very much off of their gold mining. And so when they were selling their gold, they would have to sell it at much less to what they may be worth. So this could be a major problem, and so this is why, of course, Newmont can have quite a bit of volatility, and also other gold mining companies can also have a lot of problems with this too. This company still may not be a great buy because there's likely other better companies that you could buy that wouldn't be as volatile as this. This company's assets are supporting the trading value quite a bit, which means that the intrinsic value is not going to fluctuate very much. But we have to understand as well, since the company has a tremendous amount of assets, currently at about $24 billion in shareholder equity, this means that the book value is going to be quite a bit high, and that's why we saw that it was at about $29 a share. That's very high relative to the trading value of the stock, currently at about $62 a share at the time of recording this. And also, the intrinsic value is going to be supported by this too, because that will decrease the volatility. If the company's earnings dramatically decrease, let's say, then the intrinsic value isn't going to just drop below $29 a share. But if the company were to lose a lot of money, let's say they really lost a lot of money, then the intrinsic value would actually go below $29 a share. So it's very important that this company does have a tremendous amount of assets, because this helps to make the intrinsic value at least stay at a higher value. And then this would hopefully decrease the volatility, as the stock may not need to decrease and increase at quite dramatic rates. There's certain tech companies, and this goes for a lot of tech companies actually, that may have earnings that may fluctuate quite a bit. And so this means that if the company has assets that aren't supporting the intrinsic value as much as the earnings are, this means that the earnings have a higher say in what the intrinsic value should be for the company. And so the trading value is likely going to change far more dramatically than maybe a bank or an insurance company may have. And this is primarily because the insurance and banking companies tend to have much higher asset worths relative to the trading values of the companies. Now, Newmont has offered to repurchase its own stock, which is decreasing the outstanding shares in the market, which should help to increase the book value because there's less outstanding shares in the market. Simply, the assets are distributed across less shares because the book value is the shareholder equity divided by the outstanding shares in the market. Now, we also understand that this should help to increase the intrinsic value because the book value is increasing, and so the worth of the company is distributed across less shares, and so that's very important. Now, this company does, unfortunately, although they're saying that they are willing to buy back their own stock and that they have repurchase programs that they put out, unfortunately, this company is not seemingly repurchasing too much of its stock. And so since the rate of repurchasing their stock is so low, this company is unfortunately having issues with actually decreasing the shares outstanding in the market. And so at this point, I wouldn't really consider this company to be buying back its own stock at all. And so that's not very ideal, because decreasing the outstanding shares in the market helps to artificially increase the trading value. And so that should help, of course, with capital gains and other things like that. Now, this company does offer, of course, a dividend, which is also another plus for this company too. This company's current dividend yield is about 3.5%, and this is just because at the time of recording, this company is profiting substantially. And so here we could see that here they offered a 55-cent dividend for a single quarter. And so for other quarters in the past, they decided to spread out. Sometimes they raise it, and so they really go back and forth. And so right now the dividend yield is really high, but that may change not too long from now. So in the long term, I cannot say that this company is going to be a great dividend stock. In fact, it could be actually not a dividend stock at all, as they may decide not to pay out a dividend if gold prices go down dramatically and they can't profit. So that's very important. This company does not seem to be buying back its own stock either. This company also is unfortunately very volatile at this time, despite the fact that the book value is going to be at least higher than you would expect, despite the fact that the book value is so high. So this is very important that we understand that this company could be volatile. This company is not going to be likely a very strong long-term dividend stock due to that potential earnings volatility. And also this goes for the same of increasing the company's worth and trading value because of the stock buybacks not occurring as often as we may like it to be. So by technicals, this may show that the company in the long term may not do as well as maybe another company may do. But let's say you understand that the gold price is going to go up dramatically in maybe the next 10 years, then maybe you want to be invested in a company like this, which will pay out dividends instead of just buying directly in gold. And so that's why I think some people may be interested in buying in these gold mining companies, because they're likely safer bets than buying directly in gold itself. So overall, I think that this company is currently a bit overvalued, but this company could have long-term potential if you understand how gold pricing is going to work in the future. Of course, it's hard to say, and so therefore you really have to understand the industry tremendously well and be able to predict exactly what's going to happen with gold prices, because the earnings of this company really do fluctuate relative to the price of gold at that time. Anyway, thanks so much for watching. If you'd like this video, please do like and subscribe if this is about our channel, and please comment down below and tell us what you think about this company, and we'll try to get back to you.